Welcome to House Lux Estate, where finance becomes effortlessly understandable. We're your premier channel committed to demystifying the intricate world of finance and making it accessible to all. In a world where financial literacy is paramount, House Lux Estate stands as a beacon of knowledge, guiding you through the labyrinth of investment vehicles and financial strategies. Our journey today takes us across the vast landscapes of the financial world, where we'll explore the intriguing realms of corporate bonds and government securities. These are not just investment options, but crucial tools that shape our economic landscape. Understanding them, their differences, and their unique roles in the financial ecosystem is integral to making informed investment decisions. So, whether you're a seasoned investor or just starting out, our mission is to equip you with the knowledge you need to navigate the financial seas with confidence and ease. Today, we delve into the world of corporate bonds and government securities. Corporate bonds. A term you might have heard, but do you really know what it means? Let's break it down and shed some light on the subject. In the simplest terms, a corporate bond is a loan. But instead of you borrowing money from a bank, it's a corporation borrowing money from you, the investor. Just like any loan, the corporation promises to pay you back the principal amount, also known as the face value, after a specified period. This period is known as the bond's maturity. But what's in it for you? Well, during the life of the bond, the corporation pays you interest. This interest, typically paid semi-annually, is also known as the coupon rate. The higher the coupon rate, the more income you receive from the bond. Now, you might be wondering why corporations issue bonds. The answer is simple. It's a way for them to raise capital for various purposes, such as funding capital expenditures, operations, or even acquisitions. By issuing bonds, corporations can finance their growth without diluting ownership through issuing more shares. But like any investment, corporate bonds come with their share of risks. The primary risk is credit risk, or the risk that the corporation will default on its payments. The higher the credit risk, the higher the coupon rate, and therefore, the higher the potential return. However, it's crucial to remember that higher returns come with higher risks. This is where bond ratings come into play. Bond rating agencies such as Moody's or Standard & Poor's assess the creditworthiness of the issuing corporation. The better the rating, the lower the credit risk. In summary, corporate bonds are a type of investment that can offer regular income. They can be a good way of diversifying your investment portfolio, particularly if you're looking for a higher return than what's typically offered by government securities. Corporate bonds, while they can be a high-risk, high-reward investment, are a crucial part of a balanced investment portfolio. So whether you're a seasoned investor or just starting, understanding corporate bonds is a step in the right direction towards financial literacy and independence. Now, let's switch gears and talk about government securities. At their core, government securities are essentially IOUs. When you purchase one, you're lending money to the government. In return, the government promises to pay you back with interest. This makes them a form of debt instrument, much like corporate bonds. But here's where they diverge. Government securities are issued by the federal government. So why does the government need to borrow money? Well, it's the same reason anyone borrows money, to finance projects and operations. For the government, these could range from infrastructure development and public programs to war efforts and debt repayment. Now, when it comes to safety and stability, government securities take home the gold medal. Why? Because they're backed by the full faith and credit of the U.S. government. That's a pretty big deal. It means that unless the government defaults, which is extremely unlikely, you're guaranteed to get your money back. Government securities come in a few different flavors. There are treasury bills, which are short-term securities with maturity periods of 1 year or less. Then there are treasury notes and bonds, which have longer maturity periods and pay interest every 6 months. And finally, there are treasury inflation-protected securities, or TIPS, which adjust with inflation to protect your purchasing power. As for returns, government securities typically offer lower yields compared to corporate bonds. That's because with lower risk comes lower reward. But the trade-off is worth it for many investors. Why? Because government securities provide a steady income stream and are a great way to diversify a portfolio. Plus, they're highly liquid, meaning you can easily buy and sell them on the open market. In essence, government securities are a bit like the tortoise in the fable of the tortoise and the hare. They may not sprint ahead with high returns, but they offer a steady, reliable pace that, in the long run, can lead to success. Government securities, providing a safer but potentially lower return investment, are a reliable addition to any portfolio. So how do corporate bonds measure up against government securities? This is a question that might be lingering in the minds of many, so let's dive right into it. Both corporate bonds and government securities are forms of debt instruments. They represent a loan made by an investor to a borrower, typically a corporation or a government entity. The borrower promises to pay back the loan with interest over a specified period of time. That's where the similarities end, and the differences begin to appear. Let's start with risk. Corporate bonds generally carry a higher risk compared to government securities. This is because corporations are more likely to default on their obligations than a government. Governments, particularly those of developed nations, have the power to levy taxes and print money, which makes their likelihood of defaulting on their debt quite low. On the other hand, businesses can go bankrupt, and in such cases, bondholders may lose their entire investment. Now let's talk about returns. Because of the higher risk associated with corporate bonds, they typically offer higher returns than government securities. This is the risk-return trade-off. If you're willing to take on more risk, you can potentially earn higher returns. However, it's crucial to note that higher potential returns do not guarantee actual returns. Next up is liquidity. Liquidity refers to how easy it is to buy and sell an investment without affecting its price. Government securities are generally more liquid than corporate bonds. This is because they have a larger market and are often considered safer investments, attracting a wider range of investors. Corporate bonds, on the other hand, can sometimes be harder to sell, particularly if the issuing company is experiencing financial difficulties. Lastly, let's consider the investment purpose. Government securities are often used by investors as a safe haven during times of economic uncertainty, due to their low risk. Corporate bonds, conversely, are typically used by investors seeking higher returns and willing to accept the accompanying risk. To sum it up, corporate bonds and government securities both offer unique advantages. Corporate bonds tend to offer higher returns, but come with greater risk and potentially lower liquidity. Government securities, on the other hand, are lower risk, highly liquid, and serve as a safe haven during economic turbulence. While both serve as viable investment options, the choice between corporate bonds and government securities ultimately depends on an individual investor's risk tolerance and investment goals. So, before you make your investment decision, take a moment to understand your own risk tolerance and what you aim to achieve with your investment. Remember, every investment decision is a step towards your financial future. Choose wisely. As we wrap up, let's revisit the main points from today's discussion. We started by delving into the world of corporate bonds, those debt securities issued by companies to raise capital. We learned that they often offer higher yields compared to government securities, compensating for the additional risk. But it's not all about the returns. Remember the importance of the issuing company's financial health, which can directly impact the bond's default risk. Then, we journeyed toward understanding government securities. These are essentially IOUs from the government, deemed to be the safest investment around. They may offer lower yields, but they come with the assurance of the government's backing, making them a solid choice for risk-averse investors. Our comparison of corporate bonds and government securities highlighted some distinct differences. Corporate bonds can provide a higher potential return, but come with a higher risk. On the other hand, government securities offer lower returns, but their risk is significantly lower. Understanding these two financial instruments is crucial when building an investment portfolio. It's all about balancing risk and reward, and these tools allow you to do just that. Your investment decisions should not only be based on the potential returns, but also on your risk tolerance, financial goals, and the overall economic outlook. The world of investing can often seem complex and overwhelming, but with the right knowledge, it becomes a lot less daunting. And that's what we aim to provide here on House Lux Estate: clear, concise, and insightful financial content that helps you make informed investment decisions. Before we sign off, we'd like to invite you to join our community of savvy investors. Hit the subscribe button to stay updated with our latest content and enhance your financial literacy. Thank you for tuning into House Lux Estate. Don't forget to subscribe for more insightful financial content. Remember, knowledge is your most valuable asset.